Well, there's been a lot of talk lately about the US dollar collapsing, gold running toward numbers most people used to laugh at, and silver suddenly becoming the metal everybody wishes they bought before the crowd woke up. So in this video, we're going to separate real warning signs from coin-shop panic, and you are going to walk away feeling a lot smarter and more confident about what this metals market is actually saying. Today is Sunday, May 3rd, New York time, and before we get into the numbers, comment what day and date you're watching from. I'm serious because these markets are moving fast, and I want to know where you are seeing this from. And if this kind of clear breakdown helps you, subscribe and comment John A.G. Best below. That tells me you value the work, and it helps push this content past the copy and paste noise. So, the first thing we need to understand is that a coin shop is not just a store. It is a little economic weather station. People come in happy, scared, curious, broke, confident, confused, and sometimes all of those things at once. And when a dealer says he is buying a tremendous amount of metal from the public, that can mean something very bullish or something very uncomfortable. Because yes, it can mean people are rotating into stronger positions, but it can also mean people are selling the one thing they still have when life gets expensive. That's the part everybody skips. One customer is looking at silver eagles as a gift. Another person is looking at bars. Somebody likes the look of a collectible piece. Somebody else is thinking about whether the price moved down from last week and whether it might jump again in a couple of days. None of that sounds like a collapse headline. It sounds like real life. And real life is the point. Physical metal is not just a chart on a screen. It is a gift, a savings account, an emergency fund, a family decision, and sometimes a roof repair. So when people say, everybody is selling, don't instantly assume panic. Sometimes metals are doing exactly what they were supposed to do. They store value until the owner needs value. Now, does that mean there is no stress? No, there is stress everywhere. The big debate is money supply. The simple version is this: the supply of dollars has expanded massively over the long run, and gold tends to reflect the fact that the dollar buys less over time. Based on the latest money stock data, broad U.S. money supply is still sitting around the low 20 trillion range, even after the pullback from the extreme pandemic surge. That is not a small base. That is the ocean everything else is floating in. And this is where gold becomes more than a shiny rock. If the measuring stick keeps stretching, scarce assets eventually get repriced. Not every day, not in a straight line. But over time, the market starts asking the same question. If dollars can be created politically, what do I own that cannot be created that easily? That question is why gold is back in the center of the room. But let me be clear, because this is where people get sloppy. Money supply alone does not control gold like a remote control. If that were true, gold would move perfectly with one line on a chart, and everybody with a spreadsheet would be rich. Gold also reacts to real interest rates, the dollar index, central bank buying, geopolitical fear, ETF flows, futures positioning, jewelry demand, and plain old investor emotion. So when somebody says, money supply went up, therefore gold must explode tomorrow, slow down. The direction may be right, the timing may be completely wrong. And that is why the dealer's pushback matters. He is basically saying, hold on, what about manipulation? What about regulators? What about futures contracts? What about digital assets and paper promises? Now, I don't think every downward tick is proof of manipulation. Markets can fall because buyers step away, funds rebalance, traders take profits, or leverage gets cleaned out. However, pretending precious metals markets have never had bad behavior would also be naive. The better answer is this: short-term price action can be distorted, but long-term value usually keeps pushing until it finds daylight. That is the line I would draw. Because if gold's move is only driven by panic, then it can vanish when panic fades. But if gold is moving because governments keep running deficits, central banks keep diversifying reserves, and investors keep questioning paper promises, then this is not just a headline trade, it is a trust trade, and recent gold demand backs that up. In the latest quarterly data, global gold demand, including over-the-counter activity, reached a record value, while bar and coin buying had one of its strongest quarters ever. Central banks also kept adding gold in healthy size. That does not mean every buyer is right on timing, but it does mean serious buyers are still showing up at high prices. That is important, because strong demand at high prices tells you the buyer is not only shopping for a bargain, the buyer is shopping for protection. Now, silver is a different animal. Gold is the monetary anchor. Silver is the emotional wild card. It has the money story, but it also has the industry story. Solar, electronics, vehicles, power systems, data centers, and artificial intelligence infrastructure all keep silver relevant beyond stacker psychology. And here is what makes silver so explosive. The silver market is expected to remain in deficit again this year, with physical investment projected to rebound, even while some industrial areas cool. That is a strange combination. Weaker demand in one pocket, stronger demand in another, and still not enough supply to make the market feel comfortable. So when silver moves, it does not politely tap you on the shoulder. It kicks the door open. But that also means silver can punish late buyers. It can run hard, pull back hard, and make disciplined people look foolish right before they look brilliant. So if someone says silver is going to a huge number by year end, I am not laughing. But I am also not building my whole plan around one dramatic target. Could silver shock people? Absolutely. Could it shake out impatient buyers first? Absolutely. Both can be true. Now let's talk about the dollar failure conversation, because this is where the mood gets heavy. The shop debate connects today's paper system to the old moment when Americans moved away from gold-backed thinking and deeper into Federal Reserve notes. The emotional argument is that people were tricked into accepting paper over metal. There is a lesson there, but we need to handle it carefully. History is rarely as clean as a one-sentence slogan. The 1930s gold actions happened during a brutal banking and depression crisis. Policymakers were trying to stop a system from breaking. That does not mean the policy was painless or fair. It means the big lesson is not simply, they fooled everyone. The bigger lesson is this: when the system is stressed enough, rules can change. That is the part stackers understand. They are not always predicting tomorrow morning's collapse. They are saying, I want something outside the rules if the rules get rewritten. And whether you agree with every fear or not, that instinct is not crazy. Every financial system depends on confidence, and confidence is strongest right before people realize it was weaker than they thought. Now, does the dollar go to zero next week? No, that is not my view. The dollar still has enormous power because global trade, debt, commodities, and banking are deeply tied to it. The United States still has the reserve currency advantage, deep capital markets, military power, and institutional reach. But do not confuse strength with invincibility. That is the trap. The warning is not instant ruin. The warning is slow erosion disguised as normal policy until suddenly everyone notices too late again. A reserve currency can be strong and still lose purchasing power. A banking system can function and still carry stress. A government can collect massive revenue and still run massive deficits. And right now, the federal budget picture is still heavy. Recent deficit tracking shows the government already running a fiscal year shortfall around the trillion-dollar area by early spring, even with revenues improving. That matters because deficits are future claims. They do not always create immediate inflation. They do not always break the currency, but they keep pressure on the system, especially when interest costs stay high and political leaders do not want to make painful choices. And that brings us to banks. The shop conversation mentions bailouts, rescues, and big bank trouble. Now, I would not jump from that to, your bank is gone tomorrow. That is fear marketing, but banking risk is not imaginary either. The latest banking risk review is still focused on funding pressure, interest rate risk, credit risk, commercial real estate, consumer lending, and other stress points that can get worse when borrowers weaken. So the real question is not, will every bank collapse? The real question is, if something breaks, who absorbs the loss? And historically, the answer usually spreads across society through guarantees, rescues, inflation, taxes, lower purchasing power, or some quiet policy move most people never voted on directly. That is why people stack, not because silver solves every problem, not because gold pays your electric bill by itself, but because physical metal is one of the few assets with no counterparty promise attached when you hold it correctly. A bond is a promise, a bank deposit is a claim, a stock is ownership inside a system, a digital token depends on a network. But a gold coin in your hand is not asking anyone's permission to exist. That does not make it perfect. It makes it different. And different matters when people stop trusting sameness. One of the most useful parts of the shop conversation is the longtime stacker who admits he sold too early. That story is worth more than the bold prediction at the end. He bought with conviction, took a profit, thought the move was done, watched the market teach him a lesson, and then came back with a longer horizon. That is real. Every stacker eventually faces that test, not the buying test. Buying is easy when everybody is excited. The hard part is holding through boredom, pullbacks, jokes from friends, and headlines telling you that you missed the move or that the move is over. If you do not know why you own metal, the market will eventually take it from you emotionally before it takes it from you financially. And if you're successful, share your success story in the comments so others can stay motivated. Real stories help new people more than empty price shouting ever will. Now, I also want to push back on one idea. Physical metal should not become an excuse to ignore everything else. Some people hear paper is doomed and think the only answer is to bury coins and stop learning. I think that is a mistake. The strongest people financially are not usually the ones with one idea. They are the ones with a framework. Cash for near-term needs, productive assets for growth, skills for income, no stupid debt if you can avoid it, and metals as long-term insurance against currency abuse and systemic mistakes. That is not as exciting as yelling collapse, but it is a lot more useful. Because if the dollar weakens gradually, you need a plan. If markets melt up, you need a plan. If metals pull back, you need a plan. And if nothing dramatic happens for a year, you still need a plan. That is why trust in a dealer matters too. The stacker respects the dealer because he does not just agree with everything. That is a good sign. Be careful with anyone who only sells you certainty. A good dealer can tell you when premiums are ugly, when a product is not worth chasing, when a collectible story is not worth the extra money, and when waiting might be smarter than rushing. Sometimes the most valuable thing a dealer sells is not metal. It is judgment. Now about those year-end predictions. Gold near the upper thousands. Silver deep into triple-digit territory. Are those impossible? No. In a world of policy mistakes, strong demand, and fear, markets can overshoot. But big targets need big conditions. You would probably need continued dollar weakness, serious investment demand, central bank support, fiscal anxiety, and a silver market that keeps tightening instead of relaxing. Could that happen? Yes. Should you bet your peace of mind on it? No. That is the difference between conviction and gambling. The better question is not, what is the exact year-end price? The better question is, if gold and silver move violently, am I positioned enough to benefit, but not so overexposed that a pullback ruins my decision-making? That is how grown-ups think about volatile assets. So here's the whole picture. The coin shop is seeing real activity. Some people are buying, some people are selling. Premiums are shifting, bars are moving, silver has supply stress, gold demand is still serious, the government is still running large deficits. Banks are not collapsing everywhere, but risk has not disappeared. The dollar is still powerful, but its purchasing power is not sacred. That is not a simple collapse story. It is a pressure story, and pressure builds quietly before it becomes obvious. So, no, I am not telling you the dollar dies tomorrow. I am not telling you gold and silver go straight up from here. I am saying the signals are loud enough that ignoring them would be careless. Physical metals are not about winning an argument in a coin shop. They are about having a piece of value that does not depend on someone else's spreadsheet, promise, bailout, app, or political speech. That is why this conversation matters. Because underneath the jokes, the bar choices, the eagle prices, the manipulation debate, and the bold forecasts, there is one serious question every investor has to answer. What do you trust when the measuring stick keeps changing? For some people, the answer is cash. For some, stocks. For some, real estate. For some, a business. And for stackers, part of the answer is gold and silver they can physically hold. Just remember, metal is not magic. It is a tool. Use it with discipline, patience, and a clear head. And as always, this is only my educational breakdown of the market ideas we are seeing. It is not personal financial advice, and you should never buy or sell anything just because someone online sounds confident. Think for yourself, study your own situation, and make the decision that actually fits your life.